when you hand over, your most sensitive financial details, everything really, your income, deductions, your whole financial picture, to a tax professional, what what hidden rules are actually guiding their hand?
It's a great question. Most people are, frankly, blissfully unaware.
Right. You just assume they know what they're doing.
Exactly. But the IRS has its own really comprehensive rule book, a meticulous code of conduct, actually.
For everyone, like attorneys, CPAs.
Yep, attorneys, CPAs, enrolled agents, anyone who practices before the IRS. And it's not just like a guideline.
It's the law or regulations.
It's a deeply ingrained set of regulations,
Yeah.
and they're designed specifically to protect you, the taxpayer.
Okay, so today we're not just peeking behind the curtain. We're going to step right through it.
We are. For a deep dive into this vital framework that most people just don't know about.
Welcome to the deep dive. Our mission today really is to give you a shortcut, a direct line to understanding the ethical backbone of the tax profession.
We're diving into Treasury Department Circular 230. That's the official name.
Circular 230. Okay. The regulations governing practice before the Internal Revenue Service. Sounds pretty official.
It is. And just to be super clear up front, this isn't about what the tax laws are.
Right. We're not talking about specific loopholes or, how to save money on your taxes today. That's a different conversation.
Exactly. This deep dive is all about how tax professionals must conduct themselves when they're interacting with the IRS for you, on your behalf.
It's about empowering you, the listener, with knowledge, right? Making
Yeah.
sure you know the standards, the really rigorous standards these experts you trust are supposed to meet.
Precisely. Because you do place enormous trust in them.
Okay, so let's unpack this right away. The very first question, maybe the most basic one, is what does practice before the IRS even mean?
Yeah, that's the perfect place to start.
Because it sounds kind of specific, maybe a bit like gatekeeping.
Yeah.
And why does Circular 230 get to say who can do it?
Well, the IRS is very meticulous about defining who has the authority. Because these activities, they directly impact taxpayers.
Okay, so what does it cover? Practice before the IRS is actually surprisingly broad. It's everything from representing you if you get audited.
Like sitting down with the auditor.
Yes, or handling an examination. It also includes preparing and filing documents, your tax returns, obviously, but also claims for refund, or really any other paperwork you submit to the IRS.
Even just giving advice.
Even giving advice about federal tax matters falls under it. Basically, if a professional is interacting with the IRS for you, or navigating the tax system for you, or even just advising you on IRS-related matters.
They're practicing before the IRS.
Almost certainly, yes. And crucially, that means the rules in Circular 230 apply directly to them.
So yeah, it's way more than just signing the bottom line on a 1040 form. It's any kind of representation or guidance involving the IRS.
Pretty much.
And Circular 230 isn't just like best practices, it's enforceable.
Oh, absolutely. It carries the full weight of the Treasury Department. And Subpart A, that's the first part of Circular 230, it lays out crystal clear who gets this authority.
It's a specific list.
A very specific list. These are credentialed people, folks who've shown a certain level of expertise and integrity.
Okay, so who's on the list? Who are these authorized practitioners that you, our listener, should be looking for when you need tax help? You want someone competent, right? Ethical.
Definitely. And the main categories are really well defined. First, you've got attorneys, members in good standing of the bar in any state or U.S. territory.
Makes sense. Lawyers.
Then, certified public accountants, CPAs, licensed to practice as a CPA in any state.
Okay, CPAs. Got it.
Next up, and this is a big category, enrolled agents, EAs.
Ah, EAs. I've heard of them. What makes them different?
EAs are individuals who've either passed a really comprehensive IRS exam covering, well, everything about federal tax, or they might have specific experience as a former IRS employee. They're directly enrolled, licensed by the Treasury Department itself.
So they specialize purely in tax, unlike maybe some attorneys or CPAs who might have broader practices.
Often, yes. Their focus is squarely on federal tax matters. The list also includes enrolled actuaries and enrolled retirement plan agents.
Okay, more specialized folks.
Very specialized. Think pension plans, complex retirement stuff. And more recently, registered tax return preparers fall under some of these rules too, though their practice is generally limited more to just preparing and signing returns.
Okay, so that's the core group. Any others?
Yeah, there's a catch-all for Other persons allowed to represent a taxpayer before the IRS in limited circumstances, like an officer or a full-time employee of a company representing that company.
Ah, like the company's own finance director talking to the IRS about the company's taxes.
Exactly. It ensures clarity even in those specific internal situations.
That's a pretty detailed list. So bringing it back to you, the taxpayer listening, why does this really matter? Why should you care who has this official IRS authority?
It matters hugely because these are the credentialed pros you should be seeking out,
The ones on the list.
the ones on the list. They're explicitly recognized and, importantly, regulated by the IRS. That recognition means they're held to all those tough ethical and professional standards in Circular 230.
And there are consequences if they mess up.
Big consequences, including disbarment, losing their right to practice before the IRS entirely. So knowing these categories helps you verify. Is the person I'm trusting actually operating within this official framework?
It's not just a title then. It's like a layer of protection.
It absolutely is. A layer of protection and accountability designed for you. It means you're dealing with someone who's demonstrated, a baseline competence and is subject to real oversight.
Okay, so we know who can practice. Now, the big question is how they have to operate. You mentioned Subpart B of Circular 230. That's like the core rule book for practitioners.
Exactly. This is where it gets down to the nuts and bolts. Their responsibilities, ethical duties, professional obligations. It spells out what they must do and also what they absolutely cannot do.
All right, let's dive into that. What are some of the fundamental duties?
Well, it starts right away with basics. Section 10.20 covers information to be furnished to the IRS.
Meaning they have to cooperate with the IRS.
Pretty much. If the IRS makes a proper, lawful request for information or records, the practitioner has a duty to promptly hand it over.
That sounds simple, but I imagine it gets tricky. What about client confidentiality?
That's the crucial exception, you're right, and it highlights this inherent tension in the role.
Between serving the client and cooperating with the IRS.
Exactly. The practitioner can withhold information or records if they believe, quote, in good faith and on reasonable grounds to be privileged.
Okay, so the things like attorney-client privilege.
Right.
Or maybe accountant-client privilege in some cases.
Precisely. Or the Koval doctrine, where an accountant is assisting an attorney. Those legal protections are respected. If you're discussing, say, a confidential legal strategy about a tax dispute with your tax attorney, that's generally privileged.
But it's not a free pass to just refuse everything.
Absolutely not. It's not a blanket excuse to stonewall the IRS. And there's another catch. If the practitioner doesn't have the records the IRS wants, but they know who does, maybe another advisor, or even you, the client,
They have to say so.
they have to inform the IRS. They can't just play dumb. It's this really delicate balancing act, upholding client confidentiality, which is vital, but also fulfilling their duty to the tax system. It's a specific carve-out for legal privilege, not a loophole.
Okay, that makes sense. It feels like they're representing you, but also have a duty to the system itself. What if they find a mistake, something you did wrong on a past return, maybe without even realizing it?
That's a critical scenario, and Section 10.21 deals with that directly. Knowledge of client omission. It's a core ethical duty.
Omission meaning a mistake or leaving something out.
Exactly. If a practitioner finds out about a client's non-compliance with federal tax laws, or an error, or something left off a return or document submitted to the IRS, they must tell the client about it.
They have to tell you. They can't just fix it quietly or ignore it.
They must advise the client of the non-compliance, the error, the omission. And not just that, they also have to fully explain the potential tax consequences. It's mandatory.
Now that gets really interesting for you, the listener. That's a direct protection. It means your tax pro can't just sweep problems under the rug.
Nope, even if it's awkward. Even if it means you might owe more tax or face penalties.
They have to give you the bad news.
They have to give you the facts and the potential outcomes. This ensures you get crucial advice, even the uncomfortable kind. It safeguards you from bigger problems later if the IRS finds it first. It's about giving you the chance to fix it.
Okay, so honesty about errors is key. What about just general carefulness? Getting the numbers right in the first place?
That's fundamental too. Section 10.22 covers diligence as to accuracy. Practitioners have to exercise due diligence.
Due diligence sounds important. What does it mean in practice?
It means being careful, thorough, and accurate when they prepare returns, approve documents, file things with the IRS. It also applies to the accuracy of anything they tell you, or tell the Treasury Department, whether it's spoken or written.
So checking their work.
Checking their work, being precise. And what's interesting here is how it applies to teamwork, like within a firm.
If a senior CPA relies on a junior accountant's work.
Exactly. The senior person is presumed to have exercised due diligence if they relied on someone else's work product, provided they used reasonable care in that reliance.
Meaning they can't just blindly trust the junior person. They have to supervise properly.
Right. They're still ultimately responsible for ensuring the accuracy. It fosters this culture of precision. For you, the client, it means more confidence that the final numbers are solid because there are layers of review.
That makes sense. You want thoroughness from everyone involved.
Yeah.
And you also want things to actually get done, right?
Right.
You don't want your case just sitting there forever.
Nobody wants that. And Section 10.23 addresses that with a simple but really important rule: prompt disposition of pending matters.
Prompt disposition just means don't delay.
Basically, yes. It says practitioners cannot unreasonably delay any matter before the IRS.
So if your audit is dragging on for years because your representative isn't doing anything, that's a violation.
It could very well be. This rule prevents that kind of inertia or disorganization. It ensures things move forward, which saves you from prolonged uncertainty and maybe even extra interest or penalties piling up. It's a small rule with big impact for your peace of mind.
Okay, let's shift gears to something everyone worries about when hiring a pro. The cost, fees. Are there rules about what they can charge or how they charge? Seems like an area where things could go wrong.
Definitely. And Section 10.27 covers fees pretty thoroughly. First off, it flat out prohibits charging an unconscionable fee.
Unconscionable. That sounds pretty bad, like outrageously high.
Exactly. It gives you, the client, immediate protection against really predatory pricing.
Okay, let's unpack that term unconscionable a bit. For listeners, what makes a fee cross that line? Is it just a dollar amount or is it more complex? And then let's get into those contingent fees you mentioned. That seems really specific.
It's not a specific dollar amount, no. Unconscionable generally means a fee that's so excessive, so disproportionate to the actual work done, that it basically shocks the conscience.
Shocks the conscious. Okay. So what factors determine that?
It depends on things like how complex was the case? How much time and effort did it really require? What's the practitioner's skill level and reputation? What are the typical fees for similar work in that area? It's about preventing blatant ripoffs or taking advantage of someone who's maybe desperate or doesn't understand the process.
Got it. Now, about those contingent fees, where the fee depends on the result, right? Like a percentage of your refund.
Exactly. And Circular 230 is very strict here. It lays out the only 3 narrow situations where contingent fees are allowed. In most tax work, they are absolutely forbidden.
Only 3. Okay,
Yeah.
what are they?
First, it's allowed when the IRS is examining or challenging your original tax return, or an amended return or refund claim filed shortly after you got notice of that challenge. Basically, it's about defending a return you already filed.
So if you're under audit for your 2023 return, your representative could charge a fee based on how much they save you in that audit.
Potentially, yes, in that specific context. Second, it's allowed for a claim that's only for a refund of interest and the penalties.
So not the tax itself, just fighting the extra charges.
Right, if the dispute is just about whether penalties or interest were applied correctly. And third, a contingent fee is okay in a judicial proceeding under the Internal Revenue Code.
Meaning if things go to tax court or federal court.
Exactly. Outside of those 3 very specific circumstances, contingent fees are generally a no-go.
Why are they so restricted?
It's about preventing bad incentives.
Oh.
You don't want a practitioner encouraging overly aggressive positions just so they can get a bigger slice of a potential refund, especially if that refund wasn't really generated by their unique efforts but was due anyway. These rules protect you financially and ensure more transparent billing.
That makes a lot of sense.
Yeah.
Okay, what about your records? All this stuff you give your tax pro W-2s, 1099s, receipts. Do they have to give them back? Or can they hold them if, say, you have a dispute about their bill?
That's a really common worry, and Section 10.28, Return of Clients' Records, is very clear and strongly favors you, the client.
Okay, good.
The general rule, at your request, the practitioner must promptly return any and all client records that are necessary for the client to comply with his or her federal tax obligations.
Promptly return all necessary records. Can they keep copies?
Yes, they can keep copies for their own files, but the originals, or at least reasonable access, must go back to you.
Is there any exception, like that fee dispute scenario?
There is one narrow exception. If your specific state law allows a practitioner to retain records because of a fee dispute, they might be able to. However,
Sounds a catch.
yes, even then, they must still give you reasonable access to review and copy any records they're holding on to that you need for your federal tax obligations.
So, bottom line, they can't just lock away your essential tax documents even if you owe them money. You still get access.
Precisely. They can't hold your tax life hostage. You always have a right to your own information.
And what counts as client records? Is it just the stuff I gave them?
It's defined broadly. It includes all the materials you or a third party provided, receipts, bank statements, prior returns. And importantly, it also includes any return, claim for refund, or other document prepared by the practitioner.
So the actual tax return they prepared for me is considered my record too.
Yes. Now, practitioners sometimes debate what exactly is necessary for compliance in a specific situation, but the rule strongly leans towards your right to access your own documents no matter what disputes arise. It's a key safeguard for your autonomy.
Okay, so we've covered the core duties in the direct client relationship. But Circular 230 also gets into trickier situations, right? Like dealing with people who've been kicked out of practice or former IRS employees, or even just how tax pros can advertise.
Absolutely. It's all about maintaining the system's integrity and ensuring fairness. Sections 10.24 and 10.25 deal with assistance from or to disbarred or suspended persons and former IRS employees.
Okay, what's the rule on disbarred people? Can a current practitioner work with them?
There's a very clear rule against knowingly accepting help from or giving assistance to anyone who's currently disbarred or suspended from practicing before the IRS.
So no backdoor practice for those who've been disciplined.
Exactly. It prevents them from just working through someone else and undermining the sanction.
Makes sense. Now, the former government employee part, that seems really sensitive, like the revolving door issue. You don't want someone using their old IRS connections or insider info for a new client, right?
That's precisely what these rules aim to prevent, and they're quite detailed. For instance, if a former IRS employee joins a private firm, the firm has to follow a strict isolation requirement.
Isolation requirement, like building a wall.
Pretty much, an ethical wall or screen. If there's a potential conflict of interest related to the former employee's government work, the firm can only take the case if they effectively wall off that employee.
Meaning the former employee can't work on it, can't share info about it?
Correct. They can't assist, can't share confidential government information they learned, and can't be compensated based on that specific matter.
Wow, that sounds like building an actual impenetrable wall around sensitive info. It's surprisingly specific.
It is, and it gets even more specific depending on how involved the person was at the IRS. If someone personally and substantially participated in a particular matter, say, they led the audit of XYZ Corp.
They can never work on that XYZ Corp matter again.
Never. Lifetime ban for that specific matter regarding those specific parties.
What if they were just, like, the supervisors of the department handling it, but didn't work on it directly?
Good question. If they had official responsibility for the matter but weren't personally and substantially involved, they face a 2-year ban on representing those parties on that matter after leaving the government. The cannot assist part doesn't apply here, just representation.
Okay, so a slightly less strict rule for supervisors, still a cooling off period.
Exactly. And there's one more layer. Within 1 year of leaving government, they can't appear before the IRS to influence any Treasury employee about any rule if they helped develop that rule or had official responsibility for it within their last year at the government.
So they can't write a tax rule and then immediately lobby against it for a client.
Precisely. Looking at the bigger picture, these rules are absolutely vital for maintaining public trust. They combat that revolving door problem, preventing former officials from cashing in unfairly on their public service. That would seriously erode confidence in the whole system.
Definitely seems necessary to prevent any appearance of improper influence. Now, what about something that sounds minor, like being a notary? Can your tax preparer also notarize your tax documents?
No, they can't. Section 10.26, notary, is short but clear. A practitioner cannot act as a notary public for their own clients on any tax matter they are handling for that client.
Why is that? Seems convenient.
It's about separation of roles. Your tax pro is your advocate. A notary is supposed to be an impartial witness to a signature. Combining those roles creates a potential conflict, or at least the appearance of one. It ensures the notarization is truly independent.
Okay, keeps the roles distinct. What about representing multiple clients whose interests might clash? Say, a husband and wife going through a messy divorce, but they want the same CPA.
That's a classic conflict of interest scenario, and Section 10.29, conflict of interest, has very strict rules to protect everyone involved. A practitioner absolutely cannot represent a client if it involves a conflict of interest,
Unless certain conditions are met.
unless all three specific conditions are met. It's a high bar. First, the practitioner has to reasonably believe they can provide competent and diligent representation to each affected client. They have to genuinely think they can do a good job for everyone involved without compromising anyone.
Okay, they have to believe they can handle it fairly. What else?
Second, the representation can't be prohibited by other state or federal laws. Sometimes other rules might be even stricter. And third, and this is critical, each affected client must waive the conflict and give informed consent.
Informed consent, meaning they have to fully understand the conflict.
Yes, and that waiver and consent must be confirmed by the client in writing within 30 days. It's not just a verbal okay.
Wow, a written waiver within 30 days. That's specific.
It ensures your loyalty isn't divided, or if there is a potential conflict, you are completely aware, you understand the risks, and you formally agree to it. The power is in your hands.
Transparency and consent. Definitely key themes here. Okay, let's talk about how these professionals get clients in the first place. Advertising. Marketing. Are there rules about that? Seems easy to make misleading claims about taxes.
Oh, absolutely. There are strict rules under Section 10.3, solicitation. The first part bans any public communication or private solicitation that uses false, fraudulent, or coercive statements or claims, or anything misleading or deceptive about IRS matters.
So no lies, no tricks, no pressure tactics.
Exactly. It's basic consumer protection applied to tax services.
Now this is where it gets really interesting for you, the listener, and it's a big warning sign. Can you give us a real-world example of something that would likely violate this, something to watch out for?
Yeah, the source material has a great, clear example. Imagine a small CPA firm, just CPAs on staff. They run a TV ad saying, "Our talented team of licensed attorneys and CPAs guarantees you the biggest tax refund possible."
Okay, what's wrong with that?
Multiple things, likely violating Circular 230. First, they falsely advertised having attorneys when they don't. That's clearly false and misleading.
Right. Obvious lie.
Second, and just as important, is the guarantee. Guarantees you the biggest tax refund. Guarantees in tax. Almost always a massive red flag.
Why are guarantees so bad?
Because tax outcomes depend hugely on individual facts, changing laws, and even IRS interpretations. It's rarely something you can truly guarantee. Promising a specific refund is often misleading, creates unrealistic expectations, and might suggest they have some improper way to ensure that outcome. Be very, very wary of guarantees.
That's a fantastic tip. If you see guaranteed refund, be skeptical. What about fees and ads? If they advertise a price, do they have to stick to it?
Yes. Section 10.30.2 says if they publish a written fee schedule, they have to honor those fees for at least 30 days after publication.
Okay, some price certainty.
And if there might be extra costs beyond the advertised fee, the ad has to make it clear that clients might be responsible for those additional costs. No hidden fees.
Good. Transparency again. Do they have to keep records of these ads? Like, can the IRS check what they actually said?
They absolutely do. Section 10.30.3 requires record keeping. For TV or radio ads, they need to keep a recording of the actual broadcast for at least 36 months.
3 years.
Yep. And for direct mail or online ads, they need to keep a copy of the ad itself, plus a list of who they sent it to, also for 36 months.
That creates accountability. You can't just say anything and then deny it later.
Exactly. It protects you from misleading ads and ensures fee transparency because there's a record.
Okay, here's one that seems like common sense, but maybe needs a rule. Can your tax pro take your refund check, endorse it, and deposit it for you?
Absolutely not. That's a huge no-no. Section 10.31, negotiation of taxpayer checks, is crystal clear. A practitioner cannot endorse or otherwise negotiate any refund check issued to a client.
Simple rule, but important. Why?
It's vital for preventing commingling of funds, potential fraud, and just ensuring direct financial accountability. Your refund belongs to you. It goes directly to you, not through your practitioner's bank account first. It's a fundamental barrier protecting your money.
Prevents a lot of potential mischief. Okay, last one in this section. The boundary between tax pros and lawyers. Just because someone is great with taxes doesn't make them a lawyer, right?
Correct. Section 10.32, Practice of Law, states that Circular 230 cannot be interpreted as authorizing anyone who isn't a member of the bar to practice law.
So my enrolled agent can give me fantastic tax advice, represent me before the IRS.
Absolutely. They can interpret tax laws, handle IRS procedures.
But they can't give me general legal advice outside of tax or represent me in, say, a contract dispute in state court.
Exactly. It respects the different training, licensing, and ethical codes of lawyers versus other tax professionals. Each lane has its boundaries.
All right, we've covered a lot of the musts and must-nots, the hard rules. But what about, the ideal standard? What should you expect from a really excellent tax advisor beyond just following the minimum rules? Does Circular 230 talk about that?
It actually does. Section 10.33 lays out best practices for tax advisors. This isn't about avoiding violations, it's aspirational. It's about achieving the highest quality representation for clients.
Okay, let's unpack this. This is the gold standard you should look for. It sounds like it's not just about the numbers, but the whole relationship and process.
That's exactly right. It's a blueprint for really exemplary conduct.
So what are some of these best practices?
Well, first, communicating really clearly with you, the client, about the engagement terms. What's the scope? What are they going to do? And importantly, understanding your purpose for seeking advice and how you plan to use it.
So setting expectations properly from the start, making sure everyone's on the same page.
Precisely. It avoids misunderstandings down the road. Second, establishing the facts thoroughly, evaluating if any assumptions are reasonable, and then reaching a conclusion that's actually supported by both the law and the facts.
So rigorous analysis, not just taking things at face value if they seem off.
Right. No cutting corners on the research or fact-finding. Third, advising you about the importance of the conclusions, like explaining clearly if a position is likely to avoid penalties or not.
So you understand the stakes and the reasoning.
Exactly. It empowers you to make informed decisions. Fourth, simply acting fairly and with integrity in all dealings with the IRS. Honesty, impartiality, basic ethical conduct.
Goes without saying, hopefully, but good to have it stated.
And fifth, and this is key for firms, leadership should take reasonable steps to make sure everyone in the firm, members, associates, staff, follows procedures consistent with these best practices.
So it's about building a culture of excellence, not just relying on individuals.
Yes, it has to be systemic.
This sounds like a fantastic checklist for finding a high-quality advisor. If they're doing these things, you're probably in good hands. But to do all this, they actually need to know what they're doing, right? They need to be competent.
That's the absolute foundation. And it's covered in Section 10.35, competence. It states clearly. A practitioner must possess the necessary competence to practice before the IRS.
Necessary competence, what does that mean?
The rule defines competent practice as having the appropriate level of knowledge, skill, thoroughness, and preparation for the specific tax matter they're handling.
So the required competence might vary depending on how complex the issue is.
Exactly. A simple 1040 requires a different level of knowledge than, say, structuring a complex international merger. It's not a one-size-fits-all standard.
How do they stay competent? Tax laws change constantly. Do they just get licensed once and that's it?
Oh, definitely not. The rule explicitly recognizes competence as ongoing. It requires continuous learning.
So how do they achieve or maintain it?
Through various ways. Consulting with other experts if something is outside their wheelhouse. Studying the relevant law and regulations diligently. Attending continuing education.
So it's okay if my CPA doesn't know the answer to a super obscure question off the top of their head.
It's perfectly okay. What's not okay is if they don't know how to find the answer, or who to ask, or if they just guess. Competence includes knowing the limits of your knowledge and taking steps to fill the gaps. This really raises an important point for the profession itself, ensuring pros stay current in this incredibly complex, always changing field. For you, the listener, it's reassurance. Your advisor is required to be knowledgeable and up to date, or to get the help needed to advise you properly.
Okay, we've hit broad duties, best practices, competence. Let's zoom in even further now on the actual work product the tax returns filed, the formal advice given. Section 10.34 sets specific standards with respect to tax returns and documents. This sounds like it's about the integrity of every single thing submitted. No wild guesses, no deliberate foot dragging.
Absolutely. This gets to the heart of the filings themselves. For actual tax returns, the rule is very strict. A practitioner cannot willfully or recklessly sign a return or advise you to take a position on a return if they know or should know it lacks a reasonable basis.
Reasonable basis, meaning there has to be some legitimate argument for it. It can't just be a shot in the dark.
Exactly. You need a realistic possibility of success if challenged. They also can't advise an unreasonable position or something that's a willful attempt to understate tax liability or that recklessly or intentionally disregards the rules.
So a very high bar for the positions taken. They have to be defensible.
Grounded in law and fact, not just wishful thinking or aggressive tactics without support.
Does that mean the practitioner can't just blame the client or the software if a bad position is taken? They have their own standard to meet.
Correct. They have an independent duty to ensure the positions have a reasonable basis. What about other documents besides the return itself, like affidavits or responses to IRS notices? Similar high standards apply to documents, affidavits, other papers. A practitioner can't advise taking a position on any submission to the IRS unless that position is not frivolous.
Frivolous meaning completely baseless, no chance of success.
Pretty much.
Yeah.
Utterly lacking merit. They also can't advise submitting documents just to delay or impede the tax administration process or things that are frivolous or intentionally disregard rules.
Unless. I thought I saw an exception.
There's a tiny exception. If they also advise submitting a separate document that clearly states you're making a good faith challenge to that specific rule or regulation.
Oh.
But generally, no gamesmanship, no frivolous filings.
Okay. Makes sense. It's all about preventing practitioners from just messing with the system. But what if, even with diligence, there's a real chance a penalty might apply to a position on the return? Does the practitioner have to warn you?
Yes, absolutely. This is a critical part of informed consent covered in Section 10.34 under advising clients on potential penalties. They must inform you of any penalties that are reasonably likely to apply to a position taken on a return, especially if they advised on that position or prepared the return.
Reasonably likely. Okay. Did they just tell you about the risk?
No, it goes further. They also have to tell you about any opportunity to avoid penalties, usually through adequate disclosure on the return, and explain exactly what's required for that disclosure.
Wow. So they have to identify the risk and explain the potential escape hatch, like disclosure.
Exactly. This really empowers you, the client. You get the full picture, the potential downside, penalties, and the potential mitigation strategy, disclosure, so you can make an informed decision about the risk you're willing to take. It's all about transparency.
That is incredibly important. You need to know the risks involved in your own tax strategy. Now, how much can the practitioner rely on the information you give them? Do they have to double-check every single number you provide?
That's a very practical question. Section 10.34 addresses practitioners' reliance on information furnished by client. Generally, they can rely in good faith without verification on what you tell them.
Okay, so they don't have to audit me.
Right. They aren't required to be forensic accountants for every client. However, and this is a big however,
There are limits to that trust.
big limits. They cannot ignore the implications of the information you give them or ignore other contradictory information they already know.
Like if I tell them I made $50,000, but I live in a mansion and drive a Ferrari.
Exactly. If the information seems questionable, incomplete, or just doesn't add up, they must make reasonable inquiries. They have to ask questions.
So they can trust, but they can't be willfully blind.
Perfect way to put it. They have a duty to probe if things look suspicious or don't make sense. It strikes a balance between practical reliance and necessary professional skepticism.
Okay. Now, let's talk about formal written advice.
How so?
This sounds more serious than just a quick email reply. What are the standards here? Section 10.37.
Yes, Section 10.37. And it applies to any written advice, including emails, memos, formal opinion letters concerning federal tax matters. The standards here are very high.
Okay, what do they require?
The practitioner has to base the advice on reasonable factual and legal assumptions. They need to reasonably consider all relevant facts and circumstances they know or should know. They have to make reasonable efforts to actually identify and find out the relevant facts.
So a thorough investigation is required.
Yes, they can't rely on unreasonable statements or projections from you or anyone else. If something seems fishy or unrealistic, they can't just build their advice on it.
They have to connect the law to the facts.
Rigorously relate the applicable law and authorities to your specific facts. And here's a huge one. They must not take into account the possibility that your return won't be audited or that a particular issue won't be raised on audit.
Whoa, okay, unpack that. What does that mean for me, the client?
It means the advice has to be solid on its own merits. Legally sound, factually supported. They can't just say, well, this is aggressive, but hey, you probably won't get caught. The advice has to stand up whether the IRS looks at it or not.
So no crossing fingers and hoping for the audit lottery. The advice itself must be defensible.
Exactly. It ensures the quality and integrity of the advice itself, independent of enforcement likelihood.
And federal tax matters. Is that defined broadly here? Does it cover pretty much everything tax-related?
Very broadly, subsection 5.1 makes that clear. It's anything about applying or interpreting the Internal Revenue Code, any law affecting your tax obligations, like paying tax or filing returns, or any other law or regulation the IRS administers. So yes, it's comprehensive.
What if my advisor needs help from another expert on a really niche issue? Can they rely on that other person's advice when advising me?
Yes, they can, but under strict conditions laid out in subsection 5.2, reliance on advice of others. They can only rely on another expert's advice if that advice itself was reasonable and their reliance is in good faith.
So they have to vet the expert and the advice.
Absolutely. Reliance is not reasonable if your practitioner knows or should know the other expert's opinion shouldn't be relied on, maybe it seems flawed, or if they know the other expert isn't competent or qualified for that specific issue, or if the other expert has a conflict of interest.
So they can't just blindly pass along another expert's opinion without checking it out first.
Correct. They're still responsible for the overall advice given to you.
That adds another layer of assurance. Okay, last point here. When the IRS reviews this written advice to see if the practitioner followed the rules, what standard do they use? Is it tough?
They use a reasonable practitioner standard, according to subsection 5.3. They look at it from the perspective of a competent, diligent tax professional, considering all the facts, the scope of the engagement, and how specific the advice needed to be.
So an objective professional standard.
Yes. But there's a twist. If the practitioner knows or should know that the advice will be used to promote or market some kind of tax avoidance or evasion scheme.
Like those aggressive tax shelters you hear about.
Exactly. If it's part of promoting a scheme, the IRS still applies a reasonable practitioner standard, but the implication is that the scrutiny will be much, much higher given the context. It's about holding practitioners highly accountable, especially when their advice might be used to widely market aggressive or questionable strategies. For you, the listener, this whole section on written advice provides a really strong guarantee about the quality and integrity you should expect.
Okay, we've gone through all these rules for individual practitioners. But what about the firms they work for? How does Circular 230 make sure firms are compliant? It can't just be on the individuals, right? Firms need systems in place.
You're absolutely right. Compliance is an organizational responsibility, too. Section 10.36, compliance, tackles this head-on.
How does it work?
Subsection 6.1 requires that the person or people with principal authority for overseeing the firm's federal tax practice, basically, the firm's leadership.
The managing partner or head of the tax department.
Exactly. They must take reasonable steps to ensure the firm has adequate procedures in place for everyone in the firm to comply with Circular 230.
So leadership has to set up the system. Training, internal controls, that sort of thing.
Precisely. They have to build a culture and structure that supports compliance.
What happens if they don't? What counts as a failure to comply at the firm level?
Subsection 6.2 outlines those potential failures. A failure occurs if the leadership doesn't have adequate procedures, and this leads to a pattern or practice of non-compliance within the firm.
A pattern. So not just one isolated mistake.
Generally, yes, a pattern, and that pattern has to be due to willfulness, recklessness, or gross incompetence on the part of the leadership in setting up or overseeing the procedures.
What if they have procedures but nobody follows them?
That's also a failure. If leadership fails to ensure the procedures are followed, leading to a pattern of non-compliance through willfulness, recklessness, or gross incompetence.
And what if they know there's a problem, a pattern of non-compliance, but they just ignore it?
That's the third type of failure. If leadership knows or reasonably should know about a pattern of non-compliance and they fail to take prompt corrective action. This really highlights that leadership can't just look the other way. They have a duty to actively manage compliance and fix problems when they see them. It's about proactive oversight, not just reacting after disaster strikes.
Makes sense. Accountability flows from the top down.
Yeah.
So if these rules are broken, either by an individual or because of a firm's failures, what happens? What are the sanctions for violations? Are we talking fines, a slap on the wrist?
Oh, much more serious than that. These are potentially career-ending sanctions. The power to impose them rests with the Secretary of the Treasury.
Okay. What can they do?
After giving the practitioner notice and a chance for a formal hearing, so there is due process, the Secretary can issue a public reprimand, suspend them from practice, or permanently disbar them from practicing before the IRS.
Public reprimand, suspension, or disbarment. Those sound severe.
They are. Public reprimand is a formal public shaming. Suspension means they can't practice for a set time. Disbarment is permanent removal from practice before the IRS.
What triggers these sanctions? What are the grounds?
Generally, if the practitioner is shown to be incompetent or disreputable, or if they just fail to comply with any of the Circular 230 regulations we've been discussing, or if they willfully and knowingly mislead or threaten a client or potential client with intent to defraud, it shows how seriously the IRS views these rules. Violations undermine the whole system.
Yeah, those consequences are huge. Can you give us some specific examples of incompetence and disreputable conduct? Section 7.1 in the source has a long list, right? What really stands out?
The list is incredibly broad, showing just how many ways a practitioner can cross the line. It includes things like being convicted of any federal tax crime, obviously, or any crime involving dishonesty or breach of trust, or really any felony that shows they're unfit to practice.
So criminal behavior is a clear trigger.
Absolutely. Also, giving false or misleading information to the Treasury Department or tax courts, like lying during an audit.
What about the advertising stuff we talked about? That firm making false claims.
Yes, carrying out any prohibited solicitation, like that example of falsely claiming to have attorneys and guaranteeing refunds that could definitely lead to sanctions. It's explicitly listed as disreputable conduct.
Wow. So those ads aren't just bad marketing. They could get you disbarred. What else?
Willfully failing to file your own tax returns, or willfully evading your own taxes, or helping others evade theirs, that's a big one.
They have to follow the rules themselves.
You'd hope so. Also, failing to promptly hand over client funds that were meant for tax payments to the IRS. That's a major breach of trust.
Holding onto the client's tax money? Yeah, that's bad.
Using threats or false accusations, or offering bribes or favors to influence IRS employees. Strictly forbidden. Being disbarred or suspended as a lawyer or CPA in another state can also trigger IRS sanctions.
So trouble in one profession follows you.
Often, yes. Knowingly helping someone else practice before the IRS when that person is ineligible, suspended, or disbarred is also prohibited. Even just being, quote, contemptuously abusive towards IRS employees, or making false accusations or spreading malicious libel about them can be grounds.
Maintaining professionalism is required.
And critically, knowingly, recklessly, or through gross incompetence giving false opinions on tax law questions. This goes right to the heart of the advice taxpayers rely on.
That's a huge list already. Are there more technical violations related to just preparing returns that can lead to sanctions, too?
Yes. Even things that might seem technical can be grounds if they're done willfully, like willfully failing to sign a return when you're required to as a paid preparer, or willfully disclosing confidential taxpayer information improperly, or willfully failing to e-file returns when required, or willfully preparing returns without a valid preparer tax ID number, PTIN, or willfully representing a taxpayer without proper authorization.
It really covers the gamut, from outright criminal acts to procedural violations done intentionally.
It does. And for you, the listener, this exhaustive list really underscores the layers of protection built into the system for you. It shows the wide range of unethical or incompetent behavior that's strictly forbidden and that the IRS has tools to punish. It should give you some confidence that there are real standards and real enforcement behind them.
Okay, so the sanctions are incredibly serious, especially disbarment being permanently kicked out, which leads to the obvious question, is that really permanent? Is there ever a way back? Can someone who's been disbarred or suspended ever get reinstated?
It is possible, yes, but it's definitely not automatic or easy. Section 10.81 covers petition for reinstatement. It outlines the very specific process.
What's the first hurdle? Is there a waiting period?
There is. Generally, someone who's been disbarred can only petition for reinstatement after 5 years have passed since the disbarment. If they were just suspended for a shorter period, say 2 years, they can petition right after that suspension ends.
5 years for disbarment? That's a long time out of the game. What do they have to show the IRS to even be considered? It can't just be about time served, right?
Absolutely not. Just waiting out the clock isn't nearly enough. Reinstatement is only granted if the IRS is satisfied on 2 key points.
Okay, what are they?
First, the IRS has to be convinced, based on solid evidence, that the petitioner is not likely to engage thereafter in conduct contrary to the regulations.
So they have to prove they've truly changed, rehabilitated.
Exactly. They need to demonstrate a real, sustained change in behavior, show they understand why what they did was wrong. and provide credible assurance they'll practice ethically going forward. This might involve showing evidence of things like further education, therapy, a long track record of good conduct in other areas since the disbarment.
Okay, proving personal reform is step one. What's the second requirement?
Second, and this is just as crucial, the IRS must determine that granting reinstatement would not be contrary to the public interest.
Not contrary to the public interest. What does that mean? It sounds broad.
It is broad, but very important. It means the decision isn't just about whether the individual has reformed, it's also about the impact on the overall tax system and public trust.
Could you give an example?
Sure. Imagine someone was disbarred for orchestrating a massive, high-profile tax fraud scheme. Even if, 5 or 10 years later, they can show they've personally reformed, the IRS might still decide that letting them practice again would seriously damage public confidence in the integrity of tax professionals and the tax system itself, given the notoriety of their past actions. In that case, reinstatement could be denied on public interest grounds, even if the person seems rehabilitated.
Wow. So it's not just about the individual. It's about protecting the system's reputation and the public's trust.
Precisely. That public interest factor is fascinating because it elevates the decision beyond just the petitioner's personal journey. It's about safeguarding the integrity of the entire practice for the benefit of all taxpayers. It sets a very, very high bar for getting back in after serious misconduct. Hashtag outro.
And that wraps up our really deep dive into Treasury Department Circular 230. We've kind of journeyed through this invisible shield, haven't we? Exploring how it maps out the duties, the restrictions, the ethical lines for the professionals you trust, with, frankly, incredibly sensitive financial details.
From who even gets to play in the sandbox, who can practice before the IRS, to exactly how they need to behave in every interaction.
Yeah.
Managing conflicts, advertising honestly, the diligence required.
Right, all the way to the very serious consequences, the sanctions, if they fail to meet these standards. It really does seem clear that this whole framework is built first and foremost to protect the taxpayer.
It really is. And while we didn't talk today about how to save on taxes specifically,
No tax tips today.
no tax tips, but hopefully we illuminated that crucial structure governing who helps you with your taxes and how they're supposed to operate ethically, and knowing that understanding those standards is really empowering for you as a taxpayer.
Yeah, it lets you choose more wisely and know what you have a right to expect. So the next time you talk to your tax professional, maybe remember this conversation. Remember that extensive, mostly unseen rule book, Circular 230, that's guiding their actions. Understanding these rules isn't just for the pros. It's a really powerful tool for you to help you be a more informed, more protected taxpayer. It helps ensure that the trust you place in them is truly well-founded and properly safeguarded by these regulations.